week. I hope that the quality of the video is fine and you hear me well. So let's begin. So once again, hello. This is the weekly Forex trading plan for October 3rd, October 7th. We usually prepare trade ideas for the week in order to plan our trades and to get the maximum profit of these trades. Let's see our agenda for today. It's as usual. We firstly discuss the market's positioning when we come to the economic calendar, when we switch to the Forex charts and do technical analysis, and then we sum everything up and summarize trade ideas which are derived from fundamental and technical analysis and reasoning. Firstly, let's speak a bit about the past week. And let's have a look at dynamics of the Forex measures. We can see that such pairs as Euro dollar, British pound, US dollar, dollar yen, dollar franc produced very little dynamics. Here we compare the opening price of the last week and the closing price, and the changes were very minor. From Forex measures, only Australian dollar, US dollar showed some movement, but just around of 0.5%, which is not much. We saw that market players were trying to evaluate the new kind of economic factors and economic drivers they have to deal with. Also, practically all major currency pairs are at some important levels, and for now these pairs are kind of shy to break these levels. So we see a price action which is limited by fundamental uncertainty and strong technical levels. This is the kind of framework we have to operate right now in the Forex market. I have also put gold here to compare with the move of currencies, and we can see that the metal made a significant movement in comparison with major currencies. It actually lost more than 1.5 percentage point. So this is explained by change in the market's risk sentiment and the fact that gold was more sensitive than currencies to that. Next, we come to analyzing CFTC data, or Commodity Futures Trading Commission figures. I'd like to remind you that these figures are released every Friday, and they cover the data for the week which ended at Tuesday. So here we can see the figures for the week which ended on Tuesday, September 27th. Of course, there is a time lag in these figures, but still they represent information about how big players, big money, big currency speculators are positioned, and this knowledge can help us in our trade as well. You can see that the overall bullish position for the US dollar, the net position, has increased after the Federal Reserve's meeting, and this confirms our idea that the decline of American currency after the initial disappointment that the Federal Reserve didn't raise interest rate in September on September 21st meeting. This disappointment wasn't a big negative factor for the US dollar because frankly, very little number of market players really expected the Fed to act in September. So large speculators, as we can see here, continued increasing their dollar bullish positions. The reason is that still the market expects the Fed to increase interest rates in December. And if we look at other major currencies, they currently don't provide a very good alternative to the greenback. And we'll speak a bit later about why it happens. If we look at other currencies here in the table on the right, we can see that bearish positions for the euro decreased a bit, while bearish positioning in British pound increased rather sizably. The weekly change is more than $2,000 million, so it is rather significant change. And this is the reason to believe that the British pound will remain under pressure in the coming weeks, despite the short positioning which already exists. It seems that traders and speculators don't believe that any sizable recovery is going to take place in GBP USD and in other pairs involving British pound. Also, we saw increase in bullish positioning on Japanese yen. And, this is a natural thing because of the current risk aversion mood the market is in. But on the contrary, Australian dollar bullish positions also increased a bit, not to a very high extent though. Here we can see a reflection of some optimism due to the situation in commodities, where commodity prices do behave in a rather stable fashion. So, to sum up the information we have from CFTC, I should say that the potential of these currencies versus the US dollar is very, very different. So, for every pair, we have its own fundamental reasons, and the approach to every currency pair should be unique, should be different. We now can't make any groups like commodity pairs and say that these commodity pairs, this group will perform good versus the US dollar. Because if we take the commodity currencies one by one, the situation with them is different. And so is with the so-called refuge currencies or safe haven currencies like Japanese yen and Swiss franc. The picture looks kind of different for these currencies. If we look at the US dollar index, which tracks the dynamics of American currency versus currencies of 6 US major trading partners, we can see that after the Federal Reserve, the US dollar was rather stable. This is the daily chart, and we can see that the US dollar index was fluctuating and is fluctuating around 95.50 mark. This is at the center of the symmetric triangle the US dollar is trading right now, and it is a very good reflection of the fact that the market is waiting for some new driver for the US dollar in order to break through these ranges and to show another leg of a movement which has its specific direction. So for now, we don't see such drivers. And it's interesting to make our assumptions whether we'll see any of such drivers in their upcoming week. We have our slide with economic calendar, but let's speak a bit about the US dollar in greater detail. We can see on this small picture on the right, these are the latest data for the market's expectations about the Federal Reserve's interest rate. And this data from Chicago Mercantile Exchange shows us that 55.7% is the possibility that the Fed will increase its benchmark interest rate from the current level of 0.25, 0.50% to 0.50, 0.75%. On last Thursday, this possibility was less. We had almost 50-50 chance that the US will leave rate unchanged and that the US will raise rate. However, on Friday, we got some positive news from the US, and in general, statistics released in America last week was rather positive. US GDP growth for the second quarter was revised to the upside from 1.1% to 1.4%, and the durable good orders didn't decline in August as strongly as it was expected. In addition, the Fed Chair Janet Yellen said that higher rate will likely be appropriate this year. So this statement is in line with December rate hike from the Fed. However, of course, the market will be watching the incoming data, and in order to see whether this data is enough to for the Fed to actually raise rates, because we have to see some measure improvement from the figures we saw up to September for the Federal Reserve to change its view on interest rates and to actually deliver this long-awaited interest rate hike. Yet the situation is not so simple. It all doesn't come solely to the US economic data. We have two more important factors to consider when we try to predict when the Fed will raise interest rates. And these factors are US presidential election, which will take place on November 8th, and also some external factors which may prevent the Fed from raising the rate. Firstly, let's say a couple of words about the US election. Traders will keep watching the battle between the Democratic nominee Hillary Clinton and the candidate from the Republican Party, Donald Trump. We saw last week the first debate between these two presidential candidates, and according to opinion polls, 52% of likely voters said that Clinton won the presidential debate, while 21% thought that Donald Trump was the winner. Clinton is perceived to be good for US stock market and bearish for the greenback, while Trump, on the contrary, is associated with unpredictable policy steps and some kind of policy steps which are aimed to strengthen the US dollar via some trade policies to make America more protective of its goods and the US dollar. As a result, Trump's victory would be bullish for American currency. For now, Trump is not a leader in this battle. However, his results are still far better than economists and experts used to predict. And as long as we don't know for certain that it's Hillary Clinton, not Donald Trump, this uncertainty will remain in place, and the uncertainty in this area is a supportive element for the US dollar. Another factor, I also want to add that as long as uncertainty exists, the Federal Reserve can't make this decision to raise rates. It is very difficult for the central bank to act before we know that economy and US political system will be moving in this or that direction. So we have to wait until November 8th, until the result of election. And in my opinion, even if we will watch the speeches of the Federal Reserve's members, which come ahead of this event of the US election, still they won't say what they actually think, what their actual plans are before we are not done with this election stuff. And the second important factor for the Federal Reserve and its decision making is what is happening in other economies. We remember that after the first rate hike in this cycle, which took place in December 2015, there were great problems in China. Then there was uncertainty related to Brexit, which prevented the Fed from raising interest rates earlier this year. And the current situation, the current problems with the European banking sector and primarily with Deutsche Bank can lead to uncertainty, can lead to a crisis, and this crisis may prevent the Federal Reserve from a rate hike. So Fed can say that, look, the situation is too uncertain, we have to keep our monetary policy accommodative in order to make sure that the financial system and the economy survives these negative consequences. So it comes not only to the US data and how good US economy feels, but also to the overall stability of global financial market. If banking crisis in the euro area starts to manifest itself more pronouncedly, if troubles escalate, then the Federal Reserve won't be able to deliver this hawkish stuff and to raise interest rate. So the current environment is rather complicated for the US dollar bulls. We see that if we try to return to this dollar index chart, we see that American currency lacks these reasons to take off and to break above this resistance line. Maybe after the US election, after if the European problems with banks will be resolved, or the market will get sure that they will be resolved, the possibility of the Federal Reserve's rate hike will get higher and higher, then the US dollar will be able to show significant gains. For now, it is stable. There are reasons why it is stable. Risk aversion should keep the US dollar rather balanced. The risk of the Federal Reserve rate hike will exist, and even if this risk doesn't provide a reason for the US dollar to get much higher, it still supports the currency. So in my opinion, in the near term, we have the risk of lower dollar, but not low enough to make a significant break of this support line in the US dollar index. The upcoming events we have to watch this week include ISM manufacturing PMI. The release will be in a bit more than an hour. Then there will be vice presidential debate on Tuesday. The candidates for vice presidents will just discuss and battle on key economic and political questions, so it will be also important for the election campaign. ADP non-farm employment change is due on Wednesday. Unemployment claims will be released on Thursday, and on Friday we'll get a very busy day with non-farm payrolls or NFP, with average earnings data and unemployment rate in the US. This is a block of labor market statistics, and also we'll have the speeches of a vast range of Federal Reserve speakers, and they will likely evaluate American economy, maybe external situation, and will give their opinion on the Fed's policy. So this day, Friday, should be most important for the greenback. Once again, I'd like to point out that American data should be very, very good in order to sustain expectations of the Federal Reserve's rate hike. So some extraordinary figures are needed to provoke a rally in the US dollar, while the readings which are close to consensus forecast probably won't generate a strong rally, strong appreciation of the US dollar. Let's now have a look at the overall economic calendar. Here are the most important events for all major pairs. On Monday, we saw the publication of UK manufacturing PMI, and it was positive, it was above expectations, and as I mentioned, we are waiting for ISM manufacturing PMI. On Tuesday, there will be a meeting of the Reserve Bank of Australia. According to the forecasts, the policy of the central bank will remain unchanged, and also UK will publish construction PMI. On Wednesday, another PMI from the United Kingdom, services PMI this time, and also we'll have US ADP and VP, ISM services PMI, and Canadian trade balance. On Thursday, there will be Australian trade balance and US unemployment claims. And on Friday, together with US labor market figures, we'll get UK manufacturing production and Canada's labor market data. Let's now switch to their charts, and I'll combine the fundamental outlook for the currency pairs which we are reviewing with the technical picture. As usually, we start with our main currency pair, with the euro-dollar. And a couple of words about the euro. We saw that the main source of negative impact on the single currency in the past week were the worries about the future of Deutsche Bank. I can quickly give you a sum up of what is happening with this bank. The problem is that the US Justice Department is demanding the bank to pay $14 billion fine to settle civil claims related to the dealings of this bank in mortgage-backed securities. There are reports that hedge funds started to withdraw money from Deutsche Bank, and it seems that the bank is now doesn't have enough money to pay this sum. It is going to battle with US Justice Department because it doesn't want to pay this amount. And traders are still worried that the bank won't have enough money, and it seems that German government is reluctant to provide financial help for this institution. It would be a political suicide for Angela Merkel, German Chancellor, to make this bank to give the money of German taxpayers to this bank to help it and give it bailout. So without support from government, the outlook for Deutsche Bank is really risky. Of course, there are possibilities that the bank will take some liquidity from the European Central Bank, but for now, no big announcements are made, and the future of this institution is still uncertain. Of course, there is great speculative pressure on Deutsche Bank, but this is clearly a risk factor we have to take into account. Still, we can see that despite this negative factor, this big scandal with German bank, the euro is rather resilient. If we look at the weekly chart, we can see that euro dollar even managed to close above 100-week moving average, which is currently located at 1.1212. And despite this long lower shadow, still the weekly close was rather positive for the euro dollar. Still, there was one case several weeks ago when the pair closed above this level, but this line, but didn't continue its way to the upside. So, in my opinion, the single currency is still vulnerable. We didn't see a stronger decline of the euro in the past week because German yields are rather high, while the US yields are on the downside. And still many investors think that somehow Deutsche Bank will survive, and that this bank is too big and has too great importance for the whole system of the European banks, so that somehow its problems will be resolved. So we don't see this panic have a truly big impact on the euro dollar for now, but in my opinion, the pair is still vulnerable, and still we can't consider the fact that there was rather positive close last week. We can't consider it to be the signal that we see the breakthrough to the upside here. Still, we can draw a resistance line from April highs connecting the recent August-September highs, and the pair is still lower and may still decline a bit. And if we look at the monthly chart, we see that the euro dollar remains in this kind of trendless situation. There are some positive signs, but no certainty that will get strong moves to the upside. The 50-month moving average has come dangerously close to 200 month moving average, so this can produce a negative signal in the long term. If we come to the daily chart, you can see this pivot point multi-frame time frame indicator I have put here. This pivot point for the pair is now located at 1.1223, and as long as we stay above this level this week, the picture will remain positive for the euro dollar. Below this level, the bears will get in control. On the upside, we are watching the level of around 1.1255. This is resistance line drawn through August-September highs, and then the first pivot resistance line, which lies just below 1.13 mark. The next resistance is at 1.1350. If we look at the Eurozone's economic calendar for this week, it is rather empty. There are some final PMIs, ECB monetary policy meeting accounts, but we don't have the market moving data for the region. So technically, there is positive signal. 50-day moving average went above 100-day moving average, and this is a bullish golden cross. However, pay attention to the fact that the moving averages are still mainly horizontal, and we don't see any strong momentum in this pair. It has already spent much time consolidating and moving in a more or less sideways range. And this situation may continue if the euro approaches 1.13 mark. I think that sellers will materialize. Those who think that the current situation is too unstable for the euro will enter short positions, and this will prevent the currency from gaining too much. On the other hand, we see strong support is located at 1.1170 and a bit lower at 1.1150. We have 200-day moving average around 1.1160, and these levels are guarding the euro on the downside. Next support will be at 1.11. The 4-hour chart tells us that probably the current move to the upside is over, and we'll get a period of consolidation below 1.1250 and maybe a test of lower levels in the coming session around 1.1217, 1.12. Here is what I wanted to tell you about the euro. I think that the drivers for the pair this week will be Deutsche Bank saga and US non-farm payrolls. All in all, data released in the euro area last week was mixed. German IFO business climate index exceeded expectations. The region's inflation rate increased more than expected. So all in all, the euro is supported, and probably the biggest reason why we don't see a sell-off in the euro is that there are no aggressive statements or actions from the European Central Bank. And as long as Mario Draghi doesn't say something really new, something that will increase the ECB's stimulus program, or as long as he doesn't downgrade the forecast for the euro area dramatically, the euro should remain supported. We know that European banks are currently repatriating money from abroad to the euro area, and in general, they don't invest money abroad, which keeps the amount of liquidity in the euro area high, and this is supporting the euro. Next, we come to British pound US dollar currency pair. And British pound is extremely vulnerable to the market's risk sentiment because of the British rather big current account deficit. And we can see that last week the pair was almost unchanged, but this week started with a decline, and we are currently trading below the support line, which connects post-Brexit minimums. And this looks like a very negative thing to me. Daily close below 1.2840 will be a signal to enter new short positions in British pound. One of the main sources of negative pressure on the UK currency are the expectations that Brexit may still hurt the UK economy. The UK Prime Minister confirmed that Brexit will be triggered before the end of March 2017. This is a rather close date. So the market now sees that the UK is really aims to exit the European Union, and this is a negative factor. It seems that the consolidation we saw on the weekly chart in GBP USD may finally be over, and we may finally see another leg to the downside. For such longer-term outlook, I would like to mention support levels at 1.2665 and 1.25. If we look at the daily chart, we can see that pivot support is located at 1.2840. This is already the second support, so the market moved rather actively to the downside on Monday. And the next levels to watch will be 1.2790, this is the post-Brexit minimum, and 1.2766. The economic figures from the UK haven't been bad last week. On the contrary, the GDP growth of the country for the second quarter was revised up from 0.6% to 0.7%. This week, Britain will release manufacturing, construction, and services PMIs, and will get manufacturing production on Friday. US labor market figures on Friday will also add to the pair's volatility. I would like to mention that the market still thinks that the Bank of England is likely to reduce interest rates in November, and unless UK PMI indexes, which are due on Monday, Tuesday, and Wednesday, show considerable improvement, the market will keep expecting the Bank of England to cut the benchmark rate, and we'll see lower levels of GBP USD. The first index, the first PMI, manufacturing PMI, turned out to be better than expected. However, the major part of the UK economy accounts for services sector, so data UK services PMI on Wednesday will be more important for further dynamics of the pair. And also, if concerns about Deutsche Bank and another German bank, Commerzbank, intensify, pound will feel its negative pressure and it will lose more versus the greenback. All in all, it seems to me that we should either sell the pound on its attempt to recover to 1.29 or sell the currency if there is a break below 1.2840 mark. Here, British pound looks negative. It has been looking negative for the several weeks. We saw that any attempts of pound to recover in September were shallow. We now stayed for some time at the lower border of this sideways range. We are now below the support line, and I believe there are enough reasons to believe that the further outlook for British pound is negative. Let's see now dollar yen. Here the picture is also rather interesting. Support at $100 per 100 yen per dollar still in place, and it supported the pair for the third time. However, we don't see strong bullish momentum in this pair, and all in all, this resistance line since the beginning of 2016 is still in place, and the overall trend, if we look at the weekly chart, is still negative. Factors which support demand for Japanese yen are that the market's risk sentiment is rather negative. Firstly, we have these issues with European banks. Then there is the situation with oil market. Organization of Petroleum Exporters countries decided to cut oil production for the first time in 8 years. And although it is a big step, it means that oil exporters are able to reach an agreement and to make some changes in their policy. Still, there is a lot of skepticism that this oil deal will really help the prices to, if not to gain to higher levels, but to remain at current levels. I personally believe that the problem with oil oversupply in oil market won't be resolved this way, and that oil is now vulnerable to sell off, as traders will get more and more disappointed in what the organization of petroleum exporting countries had to offer the market. As a result, I think that this oil factor will add to the market's risk aversion, and the market's risk aversion will add to demand for Japanese yen, and it will be rather difficult for the pair to break higher. Also, traders know that dollar yen is very sensitive to the US labor market data. So until we have MFP figures on Friday, there won't probably be any big positions in this pair. And also, if we look at what is happening in Japan, there are some problems there. Inflation figures released in Japan came below forecast last week. Core consumer prices contracted by 0.5%. And normally such figures would make investors think that the Bank of Japan will intensify its monetary policy easing. However, there is speculation that the regulator has reached a limit in its stimulus program and is no longer able to make the yen decline. Last week, the Bank of Japan said that it would target 10-year bond yield at levels around 0%. But this week, the market pushed the yield to, last week, the market pushed the yield to levels below zero. And in order to stick to its target, the Bank of Japan would have to reduce its massive bond purchase program. Such step, of course, will be interpreted as a sign that the central bank won't ease policy further and the yen will strengthen. For now, the Bank of Japan tries to be flexible, tries to persuade the market that the bond yield target isn't strict, so there is no need to cut stimulus. But still, I think that the market is not convinced in the Bank of Japan's stimulus program, and this is why it will be very hard for the US dollar to break above this resistance line and show any significant gains against the yen. Today we saw the pair once again met resistance in the area of 101.70, 101.80. Bigger resistance lies just above 102, ahead of 102.80 and 103.80. And below 101, the picture will become bearish, and once again we'll target 100.30 and 100 mark. The next support lies around 99.30. So to make a conclusion here, dollar yen also will likely be used for some short-term bearish positions, but we expect no big moves ahead of the US non-farm payrolls data on Friday. If we look at the 4-hour chart, we can see that the range of the pair is getting more narrow, but there are resistance levels in form of moving averages on the upside, and we are now looking forward to 101 mark on the downside. Australian dollar, US dollar made some small gains last week. It managed to rise to resistance levels around 0.77. This is a key psychological level for Australian dollar bulls. If they manage to produce a weekly close above this mark, then it will be a game changer for the pair. We will probably see higher levels. However, I think it will be very difficult for Australian dollar bulls to do that. We have the meeting of the Reserve Bank of Australia on Tuesday, and in my opinion, the current levels of Australian dollar are rather high. And although no changes in RBA's policy are expected, the central bank may somehow change its outlook. It may make comments on the current value of Australian dollar, and if some negative comments appear from the RBA, then we'll target support levels which are located at 0.76 and 0.75. All in all, taking the fact that it was hard for the pair to break above 0.77, 0.7750 in the previous months, I think that downside for this pair is more likely than the upside. I think that we have to wait and see how the meeting of RBA goes. If no significant changes appear, and if Australian dollar stays below 0.77 mark, then I think that some small shorts with targets around 0.76 are possible. Then maybe 0.75, it will depend on the market's risk sentiment. In my view, it's the most reasonable scenario. I don't believe that we'll get strong breakthrough to the upside. If last week and higher and some improvement in apex position, some improvement in oil didn't produce a close above 0.77, then the market is not sure that oil prices will continue moving higher and that Australian dollar will be able to follow it. So I wouldn't risk this pair. New Zealand's dollar also is rather calm. Here we can see consolidation. Resistance at 0.73 still isn't breached to the upside. So watch support levels. The 50-day moving average, which is currently located around 0.7240. Decline below this level will open the way down to 0.7150. We are also having a look at the US dollar. Canadian dollar, the pair failed to break above 200-day moving average around 1.3222. The results of reorganization of petroleum exporters meeting helped Canadian dollar. This week we'll get more statistics from Canada. All in all, we can't say that Canadian economy feels great. GDP figures were okay, but nothing really good to break this trend and to make Canadian dollar significantly appreciate. So here the dynamics will be more or less sideways. Traders will be waiting for Friday, then we'll get data from both Canadian and American labor markets. And some other pairs to look at. We can see that euro is gaining versus the British pound. British pound is feeling the pressure here as well. The current levels don't look very attractive, in my opinion, for long positions. So I would wait for some correction to enter the market. If we look at US dollar Swiss franc, the dynamics looks sideways. We see pretty many of resistance levels on the upside in form of moving averages. These moving averages are horizontal, so no trend moves here. And in my opinion, this pair isn't very interesting. Dollar yen is a better trade than dollar franc. And finally, looking at gold, we can see that the precious metal declined, but I believe that it is going to stay above 1,300 level. Much will depend on the outlook of the Federal Reserve, but I don't believe that this week will produce some significant signals that the Fed will raise rates. So gold should be able to recover. Also, if the market's risk sentiment gets better, then gets worse, then gold will be bought as a safe haven. So probably we should trade gold between 50 period moving average and 100-day moving average. Here is the range for the prices. I think that this is more or less all for today. Let's now make a conclusion of what we saw and what we have discussed. The current situation in Forex market is rather difficult. We have a very complex fundamental framework to operate. We have the expectations that the US Federal Reserve will raise interest rate in December, but the market is still unsure because some things can prevent the Fed from raising rates. These things are lower than expected data from the US. The uncertainty associated with US presidential elections, and also unstable external outlook, problems with German banks, which can spread to the Eurozone's banking sector. So for now, we don't have bullish impulses for the greenback, but we'll be watching the incoming data. We'll be watching US and FIPIC figures on Friday to make our judgment. All in all, American economic data has to show a very considerable improvement for the Fed's rate hike expectations to increase and for the US dollar to show significant gains. The euro remains supported despite the problems with European banks. European yields are still attractive, and European investors don't put their money away from the euro area. That's why the demand for the euro doesn't decline. There are both positive and negative moments from technical point of view, but I believe that the euro is rather well supported at 1.12, 1.1150 and 1.11. We will feel more negative pressure on the euro because of Deutsche Bank. Don't think that it was a matter of only 1 week. No, will feel more negative impact, but technically euro is supported, and however it lacks big impulses to the upside. So I think that levels around 1.13 should cap the move to the upside in the single currency and attract new sellers. So another rather quiet week for the euro dollar, as traders don't sell the euro and don't buy it either. We have this kind of dilemma for euro dollar and no big moves here. British pound may be a better currency to trade. It is vulnerable for further declines to levels at 1.2760 and even levels around 1.2660. British pound is affected by negative risk sentiment of the market and has problems of its own, like Brexit and the uncertainty that it creates. Dollar yen is limited ahead of US non-farm payrolls. Factors for the PM are mostly negative, but we still see that 100 yen support is holding, although resistance at 102 also looks strong. As long as we stay below 102, in my opinion, the outlook will be negative for the pair. And currencies like Australian dollar need to be watched. They have also approached critical resistance level. For Australian dollar at 0.77, and only above that mark long positions will be possible. The main scenario is that Australian dollar US dollar will reverse to the downside and move towards 0.76 and 0.75. This is my message for today. I thank you for your attention, and we'll see each other next Monday. We'll make another weekly outlook. We'll discuss the past week and make our new trade ideas. I thank you a lot. Thanks for attending this webinar. I remind you that my name is Elizaveta Belugina and I'm the head of analytical department at FBS. And I wish you a good trading week and profitable results. Stay tuned and be successful at Forex. Thank you and bye.